Digital Integration in Wealth Management welcomes you to this afternoon's presentation. The title of this presentation is The Future Outlook, Bracing for a Multi-Year Inflationary Upwave. This will be presented by Chairman and CEO of Charteris Treasury Portfolio Managers, Ian Williams. Topics that will be discussed are drawing attention to the end of the 20-year deflationary downwave and the start of the new multi-year inflationary upwave, breaking down what 2021 and beyond holds for wealth and investment management, hear expert insight on emerging market trends and the threat of inflation, how to stay ahead of the game, and projecting the impact on high net worth and ultra high net worth client portfolios.
Good afternoon, everyone. Welcome to our presentation. Right, so this page here, at Charteris, we run 4 funds. 3 of the funds we run are equity funds. Over the last 5 years, all 3 of our equity funds have been at the top of their respective leagues. They actually are the #1 fund in their sector, apart from the gold fund, which is #2, but that's out of every fund in the country. So that's just a little bit of backdrop, just to sort of show we sort of even half know what we're doing. So what's the next page? Okay, at the moment, we've been through a period of about 20 years of basically deflationary forces, where deflationary forces have been predominant. And this all started, you could date this back to about 1999, 2000, turn of the century, when 3 major events all come together. One was the retirement bulge of all the baby boomers that were born just after the war. They said tens of millions of Americans started retiring, which is obviously the minute they start earning money and start living on their pension, they have less money to spend. The second was the birth of the internet. This is really where the internet, and the third, which is connected to the internet, was the onset of globalization, where literally thousands of factories in America and in Europe were closed down, and the manufacturing was outsourced to China particularly, but Asia in general. And what you had is a massive sort of deflationary wave that this has unleashed. What you're now, deflation has been the predominant feature for the last 20 years. Now, what you're seeing, partly as a response to COVID in particular, but this was in train before COVID, is that central banks, led by the Federal Reserve, have been trying to deal with the deflationary consequences of this, effectively by printing money. And this is the old Irving Fisher equation, which is M is money supply, V is velocity of circulation, P is price, and T is the volume of transactions of goods. Now, so what we've had really since it started, what was called quantitative easing 1, which is initiated by Ben Bernanke after the 2007 property crash. They've been printing lots of money, but QE1, QE2, QE3, the Fed's balance sheet, which is roughly the amount of money that they're printing, expanded from $1 trillion to $4 trillion over 6 years. What we've seen in the last 12 months is the Fed's balance from 4 trillion to over 7 trillion in less than a year. And it's on course with more QE coming down the pipe, plus other things like infrastructure packages. It's on course to exceed 10 trillion. So it literally would have gone up far more. This QE4 is far more intense. It's far bigger in size. It's and whereas QE1 was really targeted to bail out the banking system in America, which it succeeded in doing, a lot of the money never really got into the real economy. It caused asset price inflation, didn't cause consumer price inflation. What you've seen with this latest QE4 is they've just been mailing $600 checks to every citizen in America. So there's been a lot more money printed, and B, it's gone directly into the economy, whereas before it tended to stay within the banking system. So if we look at the next chart, so this is just shows you the scale of it. M0, the one on the chart on the left is a monetary base. That's the Fed's balance sheet. That's how much money they're printing. The chart on the right is M2, which is the wider measure of money supply. And if you look on the chart when QE1 kicked in, 2007, 2008, after the crash, it did lead to a bit of a rise in M2, but not really very much, and it tailed off again. So the long-term trend in M2 through 2005 to 2010 was pretty much unchanged. Compare it to what's happened in the last year, it's just gone exponential. M2 in 2020 is rising at 27% a year, enormous. So if we now tie that back onto the next chart, so that's the M side of the equation. We go to the next chart, which is velocity. So what's happened since the crash is that although M was going up, this is the crash in 2007, not the crash last year. Although M was going up, V was going down, and they were offsetting each other. And as I alluded to, the chart on the right is the US labour participation rate, which reflects the retirement. So you can see it's the fall in the velocity of circulation is very closely tied to one of the key factors that's driving it, which is this retirement of the baby boom. And it also coincided with all this outsourcing and globalization. Now, what's happening right now is obviously velocity of circulation has collapsed during the COVID crisis. So yes, we've had M going up very sharply, and V has fallen very sharply. And to a certain extent, they're offsetting each other again, like they have over the last 10 years. But once the vaccination program starts to get underway and these economies open up again, velocity of circulation is going to bounce right back. There's all these $600 checks are sitting in people's bank accounts, and the reason velocity collapses is that the shops are shut, can't go on holiday, all the things that Americans want to spend money on. They've not really been able to do very much, but you know, the UK is getting quite ahead of the world in its vaccination program, and so the Americans are catching up now. I think they're up to 25 million people been vaccinated in America. So it's only a matter of time, and we're talking 2 or 3 months maybe in America, maybe only a month or two over here, before life starts to get back to normal. And when it does, V is going to bounce right back up to where it was pre-COVID. But the M isn't going to fall. The M, if anything, is just going to carry on increasing at an even greater rate, because behind the latest bit of QE, there's another stimulus package that they just voted on, 1.9 trillion, sorry. And then behind that, Biden wants to do an infrastructure spend. So the velocity is going to bounce back. So whereas before the previous QE1, QE2, QE3, the rise in M, money supply, was offset by a fall in velocity. It is that's within 1 month or 2 months' time, that's history. All you're now getting is huge increases in M that won't be offset anymore by falls in velocity. The net result is you either see huge growth, well, you will see some decent growth figures, but the amount of money that's being printed, most of it's going to end up, I'm afraid, in higher prices, not higher output. So 20 years of deflation that we've been living with. It's not going to be repeated. You're not going to find that all the factories close down in China and all move over to Bangladesh because Bangladesh undercuts China. This one-off adjustment is largely complete, and you won't get any more imported deflation from China in terms of cheaper goods. If anything, the price of Chinese goods is going to rise. You now import inflation from China because China's economy is booming. Chinese wages are rising. As we see, I think there's a couple of other slides later on in the presentation, commodity prices in the last 11 months are up on average 100%. So food, wheat, corn, they're all up 100% in 11 months. Oil, as everyone knows, has gone from $10 to $60 a barrel in 11 months. All the metal prices have gone up about 100%. So we're seeing an absolute explosion in commodity prices, which is effectively, it's this liquidity, this money that's being created by the central banks. It's not just the Fed, it's the Bank of England, they're all doing it. It's finding its way into commodity prices. And coupled with that, if you're importing a Chinese television or something, the Chinese renminbi over the last 6 months have done nothing go up. It's up about 8, 9, 10%. So stuff from China, far from being cheaper every year, is now becoming more expensive every year. So there's no more imported deflation. You're now getting imported inflation. So what's the next? If you go to the next slide. Right. So this is a ratio chart of the Goldman Sachs commodity index relative to the S&P. And as you can see, the commodities, despite the fact that we've had a huge rise over the last year, the S&P has also had a huge rise. So the ratio isn't really, although we had a big rise in commodities, they're still incredibly cheap relative to the S&P. And if you look at the peaks in 1974 and 1980, those three peaks are roughly about 18 years apart. And what we think is going to happen is that the next peak will be 18 years from the previous peak, which is about year 2026. So we foresee over the next 5 years that this commodity chart is prices are going to, even though they've gone up a long way, they're going to go up a lot more, and they're going to take it to another peak over the next 5 years or so. And just to give you a scale of the sort of movements you see, we've seen oil go from $10 a barrel in March last year. It was about $10 a barrel for the month, I think. We've seen that go to $60 a barrel in 11 months. There's no reason, and oil is supposedly a dinosaur commodity that's being phased out. But if we look at copper, for example, copper's the new age material. Without copper, you can't build any electric cars. It takes 4 times as much copper to build an electric car than it does to build a petrol car. Plus, you need copper for the charging stations. You need copper for wind farms. You need anything that involves decarbonisation and a move to electricity-based power is not possible without copper. And the stocks of copper are already starting to see copper in supply deficit. So if oil can go up tenfold in a year, there's no reason why copper can't go up tenfold, at least over 2 or 3 years, which takes it from $10,000 a ton to $60,000 a ton. So that's the sort of scale when these commodity markets start to move. You don't think in terms of, oh, they're going to go up 10% or they're going to go up 20%. They don't do, in a bull market, they don't do 10 and 20% rises. They double, they treble, they quadruple. And a lot of these car manufacturers are going to have enormous problems sourcing enough copper to make all these electric cars. It's all designing them. And the Chinese, to be fair, have already thought this out. And one of the funds we run as a gold fund, and when we meet the CEOs of all the various gold companies that we invest in, some of these gold companies are also, some of the mines are also like 40–50% copper output, but they're dual output. And all the mining companies that we're invested in that have a big copper component to their production, over the last 10 years, virtually exclusively have had approaches from Chinese mining companies to buy the mine. So the Chinese want to dominate the electric car market, and they've sussed out that in order to do that, you have to tie up the supply of copper. So the potential for these industrial metals led by copper is enormous, and so that's. But it's not. If you look at buying into this sector now, it's not like buying Tesla, which is on some ludicrous rating and carries an enormous amount of risk embedded into the price. These things on 50-year comparison charts are still very cheap. They're still very low relative to other assets. So if we look at the next chart. Right, so this is a guide to what drives US bond yield or government bond yields worldwide. During the deflation period, which we alluded to, the price of commodities will fall and US Treasury bond will fall in unison. But when the tide stops coming in and starts going out, you get a rise in commodity prices, which then leads to a rise in bond yields. And this is only in its infancy. Now, it's been on all the news channels about over the last 2 or 3 weeks that we've had a collapse in the US Treasury market. There's been some huge losses in that market. It's all eminently predictable because the commodity markets have been going up for a year. So it's only a matter of time. Anyone who even has a remote understanding of this inverse relationship, and it's the biggest driver of bond yields there is. It's nothing to do with the Fed and yield curve control, and a lot of rubbish about, you know, the Fed, like some modern day King Canute, can control 30-year or 10-year bond yields. There are powerful external forces that drive these markets. And the relationship between commodity markets and bond yields is the closest inverse relationship of any 2 markets you can find. And you can see what's happened. The commodity markets have started shooting up, been in a big bull market since March 2020, and bond yields are now starting to rise and play catch up with where the commodities are going. Okay, so, you know, when you look back, if you look back in the UK gilt market, a 50-year gilt last year was on a gross redemption yield of about 0.4%. Now, what sort of lunatic would think lending money to the UK government fixed for 50 years at less than 0.5% interest with no prospect of any coupon increases? Why people thought that was a good idea, you know, is something that will be discussed for quite a long time. But suffice to say that what you're seeing in the bond markets now is the adverse reaction to rising commodity prices and rising inflationary expectations and huge losses being generated by holders of long-term government bonds. And it hasn't finished, it's barely started. So, you know, it's not an asset class that anyone should be exposed to. Okay, so what's the next chart? So this is basically this is a Bloomberg Commodity Index, just basically stays where we think the 20-year low. One of the reasons we are pretty sure that the March 2020 low was the final low is, I mean, the sell-off was really led by the oil price trading below zero. It actually traded down to -4 barrels on the April future. Thought was possible. I mean, people didn't even think oil could go to zero and be free, but the thought that it could actually go negative. And bear markets end, big bear markets end in a capitulation sell-off. And this was a capitulation sell-off that will be written about for years as the biggest capitulation sell-off of all time. And that tells us that that's the end of the bear market in commodities. It's just a signal. And what you've got now, you don't replace a multi-year bear market, a deflationary wave, with a 1-year blip in commodity prices. This is a multi-year bull market. And when these things go, they go up in multiples of their current share price. What's the next chart? So this is, again, the inverse. This is a 50-year gilt yield or 40-year gilt yield. This is the inverse of the big sell-off in commodities. You had a big blowout top in the gilt market and the index-linked market, and what you're seeing now is losses. Anybody who bought gilts last year, long gilts 2020, has roughly lost 35% of their money already, and a lot more to come. So eventually that bond, which got up to a price of 240 a year ago, will go back below 100. So it's, you know, you've got massive, there's still yields historically very low. You've got massive asymmetric risk versus any likely reward in the bond markets. And because commodities are so bombed out and are cheap on their relative value, you've got asymmetric reward versus risk in the commodity markets and asymmetric risk in the bond markets. What's the next chart? Okay, right. Now, a lot of people say, okay, so if we're going to end the era, this 20-year era of deflation, and we're then going to go to a era of inflation, it's like purely cyclical. Tide doesn't come in forever. Tide doesn't go out forever. There's no such thing as permanent structural deflation, and there's no such thing as permanent structural inflation. They're both cyclical. Now, a lot of people say, okay, well, if we're going to go into an inflation wave, maybe the thing to buy is index-linked bonds that are quite indexed against inflation. I'm afraid to say that's one of the things, the big asset class that won't give you index protection, inflation protection, for several reasons. They're not driven by inflation per se. I know it sounds counterintuitive. They're driven by relative real yields. And just to underline the point, index-linked yields have been a really good investment during than conventional gilts. Now, I know that sounds counterintuitive, but just look how dangerous these are. Last March, this long-dated index-linked bond hit a price of 300, and within 7 trading days, this is a government bond, it's not an Argentine mining one or something. In 7 trading days, it got from a price of 300 to below 200. Right? These are absolutely lethal for people who don't understand this market. And on top of that, they're on what's called negative real yields of about 2.2%. So you don't get, they're not indexed against inflation, because inflation is 2.2%, and these bonds are on minus 2.2% real yield. Your return every year is 0%, not 2.2%, because they're on negative real yields to begin with. And not only that, they're not indexed against inflation. When index-linked gilts were issued in 1980, they were tied to what was then called the retail price index, which used to roughly go up about, when they were launched, about 5% a year. And then they brought in this other measure called CPI, Consumer Price Index, which only went up 1.5, 2% a year. So the RPI, which is a much better indicator of inflation, used to go up about 2 or 3% more every year than the CPI. Well, guess what happened? The government decided, having issued all these index-linked bonds, which were linked to the retail price index, on positive real yields of 2%, not negative real yields. So you used to get the RPI plus 2% on top, guaranteed by the government. What you get, and then they worked out that it was actually costing them too much money to pay the coupons on these bonds. So they effectively defaulted. And first thing that happened was they brought out new index-linked bonds that weren't tied to RPI, but tied to CPI, so that they didn't accrue as much, anything like as much. And then they abolished the retail price index series. So there was no retail price index to map, to calculate what the coupon should be on the original index-linked gilts. And then they just effectively told all the holders, all the original holders of the old style index-linked gilts, that going forward in future, they wouldn't be subject It wouldn't be tied to the RPI because it didn't exist anymore, and it would be tied to the CPI. So, but the CPI, the RPI was a much better indicator of inflation. And with food prices roughly up, wheat and corn and all the fruits, soybeans, all these agricultural commodities are all doubled over the last year. So it's not it's only a few, and you're going to find when you go to your supermarket that your price of bread and all the you could get petrol under a litre a gallon. Now it's 126. So that's with all the tax here. It's still 26% higher to fill up your car than it was a year ago. Food's the same way. And what you find is that the CPI doesn't accurately capture this. So you're buying a bond that's not linked to what you can visibly see is your own domestic rate of inflation, which is probably 5% a year. It's designed to an index that was deliberately constructed by the government, because it's not just index-linked coupons that are tied to the CPI. It's all the welfare payments, it's all the civil service index-linked pensions. They're all tied. So the government has this enormous vested interest in constructing some statistic that massively understates what inflation really is, because it saves them billions of pounds in money. That's what's happened. So the problem is, and you need to see, for someone to want to hold index-linked gilts and have them as a hedge against inflation, you have to have the market has to move to a level where the real yields are not negative anymore, but they go back to being positive. And then if the index-linked real yield was, I don't know, plus 2% like they were when they were first issued, even though it's still tied to an index that doesn't accurately reflect inflation, you still could roughly claim that they would be inflation-proof. But in order to get from minus 2% to plus 2% on the real yield, the existing holders are going to see their capital wiped out. To get to a positive real yield on that 50-year linker, the price would have to go down from about 250. You would have to go down to below 100. So, you know, it's potentially something to keep an eye on if the price collapses, because at some stage they may go back to being an inflation hedge. But the process where you get from A to C involves astronomical losses for the existing holders of these bonds at the current price level. So, not if you want to protect yourself against inflation, this is not the market. These are not only are they not the market to do it, you potentially lose more money than these than anything else, because the yield, the price volatility is so extreme relative to the price volatility in conventional goods. So, okay, let's go on to the next chart. I think that's, yeah, this just underlines really what we were saying. This is a real yield on index-linked gilts. It's a red chart. So it all kicked off in about 1999, 2000. You've had this constant decline in real yields, which is the other side of the coin is constant yields during a deflationary wave have been one of the best performing assets. Perversely, when that tide, which we think is pretty sure, has stopped coming out, is now coming in, they will be one of the worst performing assets during an inflationary upwave. I know it sounds counterintuitive, but that's how they trade. And that's because everyone knows we've been in a deflationary environment for 20 years, but index-linked gilts have been the best performing part of the bond market. So spin it around, when the deflationary wave ends and the inflationary wave begins, index-linked bonds are going to be one of the worst part. Okay, what's the next? Okay, that's just a sum off. So I think that's basically it. That's where we see it. We see this big booming commodity prices, multi-year booming commodity prices are looking to peak on these cycles around 2026. Big ongoing continuation of a bear market in bonds. If you want inflation proofing, if you're worried about inflation and you want inflation, buy things like our equity fund, which is full of copper miners and stuff like that, which are already seeing huge benefits of massive dividend increases, share price increases, and offer you far better inflation proofing, a far cheaper entry point with massive dividend yields relative to, you don't get a -2% in one of the big FTSE mining stocks. They're still currently yielding, despite having gone up so much. They're still on 6 and 7% yields because the dividends have been rising faster than the share prices. So there are things you can do to protect yourself from inflation. We've been doing it. This is why all our funds are at the top of the league, and we think that the next 5 years, these trends are just going to accelerate and get bigger. They're not going to go away. This is not a one-year blip. We think this is a multi-year phenomenon. And as it goes on, more and more people will clamber on board the train. And we think that's, if you're worried about up and coming inflation, these are the sort of funds and these are the sort of assets you want. Okay, I think that's the end. If you've got any questions.